Good morning. Today we begin the public hearings into Module 9, investigating the economic response to the COVID-19 pandemic. It's a subject that raises some difficult and complex issues, but I'm confident that with the help of the inquiry team, the core participants, the witnesses, the experts, and the large quantity of written material the inquiry team has gathered, we shall navigate our way through them successfully over the course of the next 4 weeks. For those who are new to inquiry hearings, and for some who are old hands, I should emphasise that they must stick to the issues that are within the scope of this module and the scope of the inquiry, and they must stick to the timings allotted to them. I shall be forced to be strict on both. I do not wish to interrupt speakers mid-flow, but I will if necessary. We shall start, as we always do, with an impact film in which we hear from a range of contributors. Some describe the financial and other impacts of the pandemic and pandemic measures on them and those around them, and some describe the impact on those whom they tried to help. There may be those who find parts of the film distressing. If you're one of those and following online, may I suggest you pause the live stream and return after about 21 minutes. If you're here at Dorland House, please leave the hearing room in a moment. The inquiry's website provides links to organisations that may be able to help, and here at the Hearing Centre we have the Hestia counselling team ready to assist. After the film has been played, we shall reassemble, and Mr. Richard Wright, King's Counsel to the inquiry, will begin his opening submissions. He will set the scene, provide some background, and explain the issues that we shall be examining in this module in more detail. I will now pause for anyone who wishes to leave the hearing room or press pause on their device, and then the film will be played. Very well, please play the film.
I've been the company director for 12 years, up to 2017, 18, 19, due to financial abuse and being left in poverty, literally fighting to survive, then picking life back up to try and get freelance work again in the industry that I loved and knew. Overnight, when the pandemic hit, that was it. Everything had gone again. No money, no work, nothing, just looking into an empty void. No savings. I had no savings, no backup, no nothing, and a mortgage and a child at home. Because I was a new freelance, classed as freelance, but limited company director, as in me as a sole person, there was nothing. There was literally nothing, no help. I had been on universal credit for a while due to low income, which was about £500 a month. To be able to pay my bills a month, nearly £2,000. Going back down to £500, it was just like, what the heck, what did we do now? And there was no answers. I was on groups of people who had nothing, and all of us literally started chipping in. If we had £5, we'd all put £5 into a pot so that maybe somebody could be sent a voucher for a supermarket. People were crying out for £20, £50, absolutely desperate. You know, people lost their homes. You know, we've all paid our taxes. We've all paid into the system for years. I mean, you know, when I had my company, I employed people. You know, paid national insurance, paid tax, corporation tax, that. All this money was paid out. And the only one thing we had to look after us in the pandemic was the government. And there was nothing. There was literally nothing. But I've been so busy trying to survive all this time that I'm absolutely exhausted. I feel like a failure as a person because I'm not working in the industry that I love, that my parents put me to college for, that I work so hard to be a part of. I think everything's gone.
During the pandemic, I was very much involved in the day-to-day running of the food bank. We had a lot of older members of the team as volunteers, so we lost a lot of our team overnight, sort of trying to work out how to navigate that, where we were going to get food from. We had people that had lost their jobs, overnight had lost their jobs, and they'd never been in that situation before. They didn't know what to do. And one that stuck with me really was a pub landlord. He was in a really desperate situation. He had, a life. He'd never experienced anything like needing a food bank before. The fact that we were able to help him with food was, a really small thing, but actually there were people like that all up and down the country.
Everything was looking rosy and everything was good. Pubs were growing from strength to strength and production was high. And then Friday, the 20th of March, we get notification that the government announced all pubs was to cease trading. It was quite distressing to see the staff concerned about when are they going to work, how are they getting paid. The furlough scheme that the government came up with was a lifesaver for small companies as we are. We did take some decisions to cut some staff back. Thankfully, 2 staff threw themselves on the swords and took retirement. But we then had to make further redundancies. One of the guys that I've made redundant, I've known him 40 years. And to sit there and say, sorry, you've got to go. It was just dark, really dark. The whole hospitality industry is a very, very fragile industry. Yeah, they had that startup grant we applied for, very easy application. Thankfully, we never used any of it and we handed it all back. It was there in case of dire emergencies, and that was the reason I took it was an interest-free loan. It was better to have it at hand should we need it rather than try and get it at the last minute.
The fact that we were given on many occasions hours to close down and leave the business, otherwise we could get into trouble. I thought they don't understand what it means closing down 3 restaurants with 55 staff, trying to console them, explain to them, apologize to them. And then when it came back, and then the restaurant's not the biggest, it's an 80-seater restaurant, and all these rules came in place, 2-meter rules, screens you had to buy. A lot of the government helped us with some money and some loans and stuff, which we're still paying back now. 3 loans, we're still paying them back. Struggling to pay bills. A lot of suppliers were very, very, very helpful. Some weren't, I don't think they thought it through. I think people just panicked and just started doing what they thought was best. And then we had the summer, we started making money again. But then you're afraid they're going to close you down again. So you're not buying too much food, you're not employing too many people. Had we not had furlough, we'd have just made all our staff redundant or fired them because we couldn't afford to keep them. So we lost business, we lost customers, we lost money, and we lost staff, and the staff didn't come back. The second time when we had to then lay off staff. And you're going to decide who to lay off because you can't keep everybody. And that was horrible to sit down and say, guys, I'm sorry. Only so much funding, only so much money left in the kitty, But as an owner, you got hit in so many ways.
I was a freight train driver. And I continued working during the lockdown. I did manage to catch COVID in May 2020. And then it just triggered what is called post-COVID ME. And since then, I've been unwell and unable to work. I did get some money related to the COVID. My employer got it for me, I think. They kept me on for a very long time. But then after a while, they realised that I wasn't improving, so they made me speak with a medical advisor. And so he suggested they take away my job. If I found a cure, I'd be straight back to work. I love my job, so I'd be happy to go back to it if they would take me.
I have no shame in admitting that I receive disability living allowance. I'll always be grateful for the financial help that a lot of people got during COVID, and that was really helpful, but it took no account of people's individual circumstances. When we talk about financial help, we talk about the employment schemes, we talked about furlough, we talked about all of these things. But nobody thought about, what about the people who aren't working? What about the people who use benefits day to day, but their circumstances have suddenly changed and now that support isn't quite enough? What do we do then? And so finances is something that we need to think about as a country. We need to look back on it. We can't just talk about the cost of living crisis now, because I'll tell you something, we had a cost of living crisis back then.
We had a flurry of emails, phone calls from clients basically stopping their services with us. Or we were working with restaurants, we were working with estate agents, we were working with commercial property agents. They didn't have businesses anymore. It's put the fear of God into us. It scared us. This is our business, gone. I'm a single dad. I've got responsibilities, financial responsibilities. I've got a mortgage, I've got loans. And then, of course, your thoughts turn to our employee. And she was sort of on the phone a lot, sort of, what's going on? And we didn't know. We genuinely didn't know. You're having stuff coming from the UK government, stuff coming from the Welsh government. By putting her onto the furlough scheme, it did help us a lot, because I think it was 80% of her salary was covered. And she was just thankful to keep her job. I do remember the councils made us all aware of the business grants that had become available. And I have to say, the application process for that was really easy, really straightforward. And before we knew it, we had some money coming into the bank account. We used the business bounce back loan as well. A very straightforward application process. The decision was made quickly as well. We had that. It just provide you a little bit peace of mind, I suppose. It gave us a little bit of a sort of safety net. Should the bounce back not have been so good for us, we had something there just to keep us going a little bit.
We had like the best January at work ever for the t-shirt printing, and the phone stopped ringing, email stopped coming through, and at that time of year, it's kind of like the start of event season, and there was roughly 3 people helping out most days at the office. And he just went to, nothing, no work on him. So we just, hunkered down and, lived this very simple life. The COVID loans and those bits and pieces came in really well, and they helped a lot. The bounce back loans, we just put the money into the bank. And I know a lot of people spent them straight away. We went from an office, the woman was really helped us out, and she kind of didn't charge any rent whilst COVID was going on. Towards the second year, she charged us half rent, but by that time, we realised that we could actually do what we needed to do from home. So we moved the operation to the house. It just operates from the spare bedroom now. So very small t-shirt printing.
A lot of the work that I had lined up was postponed at the time. Jobs slowly started to open back up, so the odd job would happen. Everything was very uncertain, and I'm someone that doesn't usually deal well with uncertainty. I like to kind of be organised and plan things. So it was the odd job that got me through, but my focus wasn't, I guess, making money. It was more, how am I going to keep doing what I love and perform? The self-employed SCIS grant. So I remember there was a whole process of not knowing which one to apply. Loads of people were trying to apply for different pots of funding. Unfortunately, I was eligible for that one. I think that's also why, I guess, financially I was thinking I'm okay. I'm moving back home and I was with family and staying with a friend, so I didn't have to worry too much about the finances, because some of the loans you had to pay back, and I know some people then were struggling to even pay things back. I did try applying for, I think, Universal Credit, and it was so complicated for me to explain what it is I do and that I'm a bit freelance, but I have these other forms of income, that in the end I just gave up. I said, there's no point me even applying for this. I had that grant and I said that will just have to do for now, and I'll try and get some other freelance work if and when we're able to do that. As the creative industry, it was the one that you couldn't prepare for the most, because there's so many freelancers in that business and you rely so much on freelance jobs. I know some people, like I said, had to get jobs in completely different industries just to survive.
I'll start by saying I employ 7 people through direct payments and the Independent Living Fund. When COVID started, I had a couple of care companies in doing small calls, 15 minutes. I had issues with staff washing their hands. If they weren't washing their hands to start with, how were they going to manage with a much more serious and deadly infection? I cancelled both of those agencies, and my own staff started picking up those bits of work. So money was a big issue. Just making sure I was safe and my workers were safe. There was quite a bit of additional cost. But I have to say the health service, and particularly independent living service kicked into play and got me through that. It would have been a real problem if the money hadn't been there, because I wouldn't have been able to look after myself properly at all. We can plan for things that make it easier in the future, and we should learn from this, because I think it would be a travesty and a tragedy if we let it go and don't learn.
So we kind of became a source of information and advice, particularly because the rules kept changing. What we were dealing with was so much uncertainty. And I think people find uncertainty hard, but when it's in your working life, your personal life, it's global, that's everything together. That's really, really difficult. Very quickly, the government in Scotland put out £70 million to made it available for the sector. We were asked to distribute that, and we had like a long weekend. It was to make it really accessible and to take away all of the nonsense that you usually have to do in applying for grants, but keep it robust. So it was get it out quick, but make sure you weren't giving it to some dodgy character, because even then there was scammers trying to access that kind of money. But it was absolutely a lifeline for organisations out in the sector. Before we were in the building that I'm sitting in now, we were in a very historic building. We were the overall leaseholder, and it was a church. The upper floor, the nave, is used for big corporate events, weddings, and we got commission from those, and that completely stopped. And we had to keep it heated at a specific temperature throughout lockdown, so the murals weren't destroyed. So we still had the outgoings on energy, despite having no income.
I'd left the army in 2010, set up my own business, and I became a self-employed pet sitter. And I loved my job, absolutely loved it. And I remember saying goodbye to the people. See you in a couple of weeks, I said. It never came back. We were told about the SEISS, where you could go online and claim some money. I truly believed that we would be looked after. And I put it in, my in the computer, and it just said, you're not entitled. Why am I not entitled? I'm self-employed. This is what you're telling me. I should be able to get some kind of financial help just during this period. And I didn't get anything. I couldn't sign on because I have an army pension. The army pension wasn't index linked, so it was only a few £100. My particular reason for not getting it was the 50% rule. The 50% rule means you had to have 50% of your self-employment to be able to actually claim. Mine was 48%. 52% was my army pension. That's why I didn't get any help. And that I do not understand. It became really, really intense, and it got to a stage where I eventually decided I didn't want to be here anymore. I managed to reach out to the people that help you, and they helped me through that, and they brought me back to some kind of normality. And so I eventually just decided to get on with it and try and help the community, try and bring some good into this awful COVID business. We basically provided all this food to these people that were struggling, and all my savings went. I haven't got any savings now. I've never recovered, and you can tell in my voice, I'm still affected, and I don't know if I'll ever get over it, but I'm living with it, and that's what I'm going to do. People like me, who's done 22 years for their country, are proud people. We don't ask for help. We are the ones that help others. I just think it should be more fair.
Suddenly your livelihood is taken away from you. You lose your self-esteem. You lose your dignity. You kind of feel embarrassed because you can't provide for your family in the way that you want to. You were sort of imprisoned in your own place with no form of income. And then there's a whole load of uncertainty with everybody else that's panicking, that's your customers. What do we do? It was devastating. And then you started seeing the reports of people losing their businesses, losing their homes, and taking their lives. It was, in a word, haunting for me, because as a limited company director, the majority of your salary is made up through dividends. Whilst the government recognises dividends in a way that they can tax you on them, they didn't recognise it as a way of an income. We're a family of 4. We had 2 teenage children. I was receiving money that was less than my mortgage each month. Now, if I'd have been self-employed, because I know many other photographers that are self-employed, they got 80% of their average wage for the previous 3 years. Where's the fairness in that? The amount of online abuse I received, telling me how I'm a tax dodger, I'm this, that, and the other, I'm scum of the earth, and I don't deserve anything. I pay more taxes than everybody else because I pay corporation tax, I pay national insurance, I pay company national insurance. I don't tax dodge. I work in the system that was set up for us. And I mean, I even had family members that didn't understand my situation. You know, there'd be debates and division in the family. You were just beaten down. Everywhere you turned, you were just beaten down because there was no support. For people like me, there was just no support.
We've been told that we have to close our businesses and stop working, and yet we have no other financial means coming in. A lot of us didn't qualify for universal credit. The financial situation for a lot of people, their finances have been decimated. All their savings have gone. They've cashed in their pensions. They have maxed out their overdrafts, their credit cards. Obviously, there were bounce back loans on offer. However, they were only offered to people who had been trading for over 2 years. So people started selling their cars, their houses, their family heirlooms. We had people selling their wedding rings, talking to people that had resorted to prostitution. We had parents that, parents who skip meals so they could feed their children. Absolutely devastating. People at a time when they were scared anyway because there was this invisible virus, they were petrified financially as well. So they were getting pressure, financial, emotional, mental health issues all around them. Also, we had a lot of members whose family members or friends went into hospital with COVID, a lot of whom died of COVID, and a lot of people imploded. I remember the first attempted suicide for the rest of my life. I took the call. I kept him on the phone for 4 hours, trying to convince him that taking his own life, it wasn't going to enrich anybody else's life at all. It wasn't the way to solve a problem. We've got people who are, they've been made bankrupt. They've lost their businesses. We've got a lot of marital breakups, couples breaking up because of the stress. I don't want anyone to feel that they've been left on their own. So until the last person has got back on their feet, we will carry on doing what we're doing.
Thank you very much. Mr. Wright.
On the 14th of February 2020, the day after he had been appointed as Chancellor of the Exchequer, Rishi Sunak received an internal briefing paper prepared by Her Majesty's Treasury. The paper was titled "The Potential Impact of the COVID-19 Coronavirus Outbreak on Global Growth and Financial Stability." It observed that on the then assumed reasonable worst-case scenario of between 25 and 50% of the UK workforce becoming infected in a pandemic that lasted for 4 months, GDP could be estimated to be between 0.6% and 1.3% lower than expected by 2021. Within weeks, that reasonable worst-case scenario for the United Kingdom economy had been overtaken by global events and consigned to history. The only element of the briefing note that held good was the concluding observation that with little data or precedent, uncertainty surrounded any estimates of economic impact. By the 20th of April 2020, a further internal paper prepared by Her Majesty's Treasury concluded that the United Kingdom economy was effectively in hibernation. The action taken by the governments of the United Kingdom and the devolved nations to combat the risk to public health posed by the virus had resulted in a cessation of economic activity across large swathes of the economy. Data from the most recent quarter, in which just 16 days had been affected by social distancing measures, recorded a fall in GDP at the sharpest rate since the general strike of 1926, and the Office for Budget Responsibility was predicting the largest fall in United Kingdom economic output for over 300 years. By the end of 2020, that prediction was confirmed as a hard reality, with the data demonstrating a fall in GDP of 10.3% over the course of the year. That figure representing the most significant annual fall in GDP in the United Kingdom since the early 1700s. If the economic shock of the pandemic was unprecedented, then so was the response of the government in attempting to meet it. On the 17th of March 2020, in a speech in Downing Street, the Chancellor of the Exchequer declared that the coronavirus pandemic is a public health emergency, but it is also an economic emergency. We have never, in peacetime, faced an economic fight like this one. He continued, this government effort will be underpinned by government interventions in the economy on a scale unimaginable only a few weeks ago. The cost of the interventions taken by government necessitated an unprecedented surge in public expenditure. Predicted to cost in the region of £350 billion at the time the support was announced, by 2023, the Treasury estimated that the total spending of government across all schemes was £373 billion. The pressures on the public finances caused by the pandemic were not just a result of that government spending. They were also the result of the other economic effects of the pandemic. As economic output fell, so did tax revenues, whilst tax compliance also declined. This massive rise in spending was funded through borrowing, causing an unprecedented sharp increase in public debt. Borrowing during the pandemic contributed to a near tripling of debt levels since the onset of the financial crisis in 2008. All of these high-level statistics, of course, translate into the experiences of individuals throughout the United Kingdom who found themselves rapidly and severely impacted by the economic shock of the pandemic. One contributor told the inquiry's listening exercise, Every Story Matters, about their own experience as a small business owner in this way. One awful day, I had to call 80% of my staff and tell them that we had to make them redundant because there was no job for them anymore. And I cried. I didn't sleep all night. I was so upset. I had people that had worked for me for 7, 8 years that I had to say, I'm so sorry. I literally can't afford to pay you anymore because we've got no business. In the course of these public hearings, we are going to hear from witnesses whose evidence can helpfully be considered under a number of broad subject headings under which we will focus our investigation. First, we will examine the initial economic response to the pandemic. That will necessitate exploring the scale and nature of the economic shock that was being faced, the relevant economic considerations of government in responding to that shock, the range of viable policy options open to it, and the early measures implemented, particularly the announcement of furlough, a truly significant and unprecedented moment in United Kingdom economic history. Second, we will explore the economic decision-making systems and structures through which the UK government and the governments of the devolved administrations formulated economic policy. This will necessitate an examination of the advice received by government, the success or otherwise of cross-government working, and the sharing of data and analysis. Third, we will examine the monetary policy decisions taken independently by the Bank of England that complemented the fiscal response of government. In particular, this will entail consideration of the reduction in the bank rate and the rounds of quantitative easing that the Bank of England undertook. We will explore these issues in the context of the nature of economic shock caused by the pandemic and how bank policy aligned with that shock. Fourth, at a high level, we will consider how the government funded its fiscal interventions on a UK-wide level, and how emergency funding for the devolved administrations was determined and delivered. We will go on to consider how local authority funding was determined and administered across the four nations of the United Kingdom. Fifth, we will consider the key measures taken by government to support jobs and the self-employed, with particular focus on the Coronavirus Job Retention Scheme and the Self-Employed Income Support Scheme. Under this broad heading, we will also explore the other key schemes that were introduced and designed to rebuild and restart economic activity as restrictions were eased, such as the Kickstart and JETS schemes. Sixth, we will explore the delivery of support for business, including through the various loan and grant schemes that operated on a UK-wide basis and through some of the discrete schemes implemented by the devolved administrations. Seventh, we will consider the steps taken by government to alleviate economic hardship, understanding that inequalities existed in both the labour market and the economy before the pandemic and were exacerbated during it, and examining the policy approach to this issue. We will explore the uplifts to universal and working tax credits and the support given to the voluntary and community sectors. Eighth, and finally, we will conclude by considering steps that might be taken to manage risk and better safeguard public funds in any future pandemic, acknowledging that there is an inevitable trade-off between the need for a speedy response to an acute shock and the risks to the public purse from fraud, error, and the delivery of untargeted support that does not provide value for money or have a positive economic benefit. At the heart of this final strand of investigation is a consideration of the importance of data and analytical capabilities across the United Kingdom government and the devolved administrations. Across each of these areas of investigation, it is important to acknowledge that the scale, speed, and depth of the economic shock faced by the United Kingdom and by the global economy was indeed unprecedented. Any policy response was being formulated at pace and without any clear timeline of the likely duration of the pandemic or the severity of its consequences. Your ladyship will of course be careful not to approach your investigation in this module by applying an artificial perfect hindsight to the economic decisions that were taken, but will consider the steps that were taken in their proper context. We will be exploring bold decisions that on any view were implemented at speed and intended to deliver immediate and tangible benefits to business and individuals facing a storm of economic uncertainty. Equally, where subsequent events may have demonstrated missteps or questionable policy decisions, we intend to explore them fully. We intend to do so in order that your ladyship might identify appropriate lessons that can be learned, alternative approaches that could be considered, and improvements that should be made to better facilitate the delivery of economic support in any future pandemic. Economists, as an academic community, are unlikely to ever reach a consensus of opinion on any or all of the issues that your ladyship is considering in this module. For that reason, our investigation is not in the form of a crude success or failure evaluation of the various measures introduced by the governments of the United Kingdom and devolved nations in the course of their economic responses. Any attempt at such an evaluation immediately runs up against the problem of a lack of any counterfactual scenario against which to test the UK response. Similarly, we may note from time to time that alternative approaches to the delivery of economic support were taken by other nations, but we do so to identify the range of potential policy responses in any economic emergency, and not in an attempt as a comparative analysis of the success or failure of those differing approaches. Having outlined the overall approach to your ladyship's investigation in this module, I turn now to each of those 8 subject headings to expand where appropriate on the issues that are likely to be engaged in the course of our hearings over the next 4 weeks. The initial response then. If the speed and scale of the economic impact was unprecedented, it was perhaps not entirely unpredictable. As James Smith observes in his expert report, historical experience supported the proposition that whilst the pandemic was fundamentally a health crisis, it was one that would inevitably do great economic damage. That damage would be occasioned both by the direct impact of the virus on health and also as a result of the steps taken, whether mandated by government or voluntarily by the public, in response to that health crisis. For instance, the impact of social distancing would have an inevitable effect upon incomes, public confidence, the labour market, and supply and demand in the economy. Each of those short-term effects, in turn, had the potential to translate into longer-term effects on jobs, investment, and productivity. On any view, this was an economic shock of a very different kind to that experienced in previous economic downturns. The closing down of significant sectors of the economy had an immediate and massive impact on the demand side of the economy, as any spending that was tied to face-to-face interactions collapsed overnight following the announcement of the first lockdown. Moreover, there was also a significant supply-side shock to the economy, occasioned by the closure of those sectors. Workers were unable to go to work. Productivity reduced. And even when sectors of the economy were able to reopen, they were less productive than they had been prior to the pandemic. Even in sectors that were not shut down, supply-side shocks were present as the virus increased absenteeism, either directly through the illness or as a result of employees having to discharge caring and caregiving responsibilities. The additional supply-side nature of the shock caused by COVID marked out the pandemic from previous instances of financial crisis and necessitated a policy response from government that addressed both the supply and demand shocks. Appreciating and understanding the scale and nature of any economic shock is comparatively easy to do after a long lag during which official statistics, founded on hard data, become available. In contrast, those making policy decisions at pace in the early stages of the pandemic did not have access to that data set. And so we're having to make decisions in the face of a rapidly worsening crisis by reference to a wide range of higher frequency proxy data. One example of that data is the record of the number of claims made for universal credit. A 20th of April 2020 briefing to the Chancellor suggested to him that between the 16th of March and the 20th of April, the number of claims for universal credit increased by 1.5 million, with 1.1 million of those claimants not in employment, an indicator of large increases in job losses. Because the pandemic was primarily a health emergency tackled by restrictions on human interactions, the economic shock was highly uneven. Those sectors of the economy that relied on human contact, such as the hospitality sector, saw the greatest falls in economic output. The extent to which a sector would be economically affected was intrinsically linked to the dependence of that industry on face-to-face interaction and the extent of health restrictions on such interactions at any given time. The uneven sectoral impact translated into a significant variance in economic impact on the labour market by age and income. Those who worked in sectors that were more significantly impacted by restrictions were already typically low earners compared to workers across the economy as a whole. As James Smith has observed in his report, 80% of social housing tenants worked in sectors of the economy that were most significantly affected by social distancing. Fewer than 1 in 10 low earners were able to work from home, compared to half of those in the highest paid jobs. Furthermore, the financial vulnerability of low to middle income families prior to the pandemic was significant, with 55% of adults in those families reporting no savings to which they could have recourse. A pandemic that disproportionately affects those on lower incomes amplifies the economic impact, indicating the need for a large-scale policy response. The unequal impact of the economic shock on different sectors of the economy and on different individuals was summed up by a contributor to Every Story Matters, who was self-employed as a freelancer in this way. I was, at the time, and still mostly am, a freelancer, self-employed performer, musician and technician for live events and occasions. And I was on tour with the circus. As both freelancers working in the live event industry, we were both unemployed, largely. In some circumstances, people were just working from home and all that. There wasn't really an option for us. Another self-employed person related that we were living on next to nothing financially. We were living on very basic food because we could not afford to go and buy anything other than very basic food. Everyone was doing the same thing. We weren't special. Just to pay the bills that mattered, the rent, the electric, the water, the council tax, the lease on my van, because I still had to keep my van. The impact on family finances was also uneven, as between lower and higher income families. Those on higher incomes reduced their expenditure as social distancing restrictions impacted their pre-pandemic spending. This resulted in savings being accumulated by those who were already better paid. In contrast, those on lower incomes reduced any savings and were more likely to resort to reliance on debt, often debt that would prove expensive to service in the longer term, such as credit card borrowing. A further contributor to Every Story Matters said that my wife had left a 0 hours contract with her work, so was not entitled to maternity pay. This situation was very, very stressful, and I'm still recovering from the financial strain. We still had all the rent and bills to pay, nappies and baby formula, food. We just survived. It is also important to acknowledge that there were very real reasons to believe that the severe economic shock could precipitate another financial crisis. The Bank of England had been clearly warning of the low levels of liquidity and risks in the financial system since the 2008 financial crisis. And in the early stages of the pandemic, levels of volatility in the financial markets were at levels even higher than during that crisis. Government decision makers were therefore, in short, having to design a response to a deep economic shock that was uneven in its impact and distribution, posed significant risks to the financial markets, was of an uncertain duration, and presented uncertain potential long-term effects. Not least of the potential long-term effects that policymakers had to consider was economic scarring, a phenomenon that can arise in a number of different ways. Periods of unemployment can lead to longer-term negative labour market outcomes. The successful matching of skilled workers to jobs can be disrupted, which in turn can prolong the process of economic recovery. The collapse of firms that, but for the pandemic, had viable futures, was also capable of scarring the economy in the longer term. The design of any immediate response to the pandemic ought to have had regard to all of these factors. However, those making very significant decisions about the economic response were not doing so with a free hand, in which they were only concerned with how much money to distribute. This was the formulation of a macroeconomic response that had to be grounded in hard economic reality and balance a myriad of factors with the long-term aim of propping up the economy, reducing scarring, and enabling recovery once the pandemic had passed. A number of objectively justifiable policy options were available to decision makers, but there were inevitably going to be trade-offs between all of them. It is also important to bear in mind that there was arguably a pressing need to reassure the public in a time of national emergency that their jobs and economic welfare were being protected insofar as that was possible. As the Chancellor said in his budget speech on the 11th of March 2020, "I will do whatever it takes to support the economy." One key consideration was the extent to which policies designed to stimulate demand were appropriate given the nature of this shock. In a typical downturn, macroeconomic activity can be restored more quickly by policy action taken to increase consumer demand. This can be achieved by increasing the amount of money available to spend, for example by monetary policy or income support. The difficulty in this emergency was that the shock occasioned was both on the supply and demand side of the economy, a subject to which I'll return when dealing with monetary policy. Ordinarily, targeting support on less well-off groups may result in additional levels of consumer spending than when targeted at other groups. This tends to mean that measures that support the most vulnerable can tend to have a greater macroeconomic stabilisation effect. But the pandemic was no ordinary economic shock. The uncertainty here was so great that even if additional funding was provided, it may well have been saved and not spent. This has the potential to create further economic danger if that money is then spent at the wrong time, for example, when the emergency has passed, as that may create inflationary pressure in the economy. A second key policy consideration was the desirability of preserving the pre-pandemic economic structure. Preserving employer-employee relationships within businesses that had a long-term viable future would arguably hasten the post-pandemic recovery and lessen economic scarring. This points towards a policy response of business loans and grants and job retention through a furlough-type scheme, though even that response was not risk-free. Labour markets need churn as employees move to better or more productive employment and job-to-job movement in which skills are matched to jobs within a framework of career progression, and that's a sign of a healthy market. By its nature, a healthy economy will see less productive firms fail as more productive and innovative firms replace them. Freezing the job market prevents this churn and can result in a mismatch between workers and jobs. The longer the freeze continues, the greater the concern. There was another risk in that the nature of the pandemic crisis had the potential to have an impact on the structure of the economy in the longer term. The danger in maintaining the pre-pandemic status quo risked businesses being preserved only to find that they had no post-pandemic future. A focus on pre-existing structures also risks discouraging innovation and adaptation to the new and emerging economic environment. The final major trade-off in policy response can be seen in the tension between the need to deliver support at speed on the one hand, as against the ability of government to fine-tune the delivery of that support on the other, so as to better prevent fraud and error and to more accurately target the support given where it was most needed and most appropriate. Against those broad policy considerations, the initial response to the pandemic by the government comprised 4 core elements. First, an integrated system of income and job protection delivered through the Coronavirus Job Retention Scheme. The scheme combined a number of policy objectives, and that it 1. Preserved job matches, 2. Protected the incomes of employees, and 3. Stabilised demand in the economy. Second, income protection without job preservation, delivered by the temporary uplift to universal credit and working tax credits. Third, a package of support for business through the delivery of grants, reliefs, and loan schemes. And fourth, demand stimulus, for example, by reductions in the VAT rate, those fiscal interventions being complemented by monetary policy decisions taken independently by the Bank of England, which acted on the 16th of March to cut the bank rate from 0.75% to 0.25% before making a further reduction to 0.1% on the 19th of March. Decision-making systems and structures. And I turn now to that second broad subject area, the systems and structures through which the economic policy objectives of government were implemented. Some of the most significant support schemes, in particular the Job Retention Scheme and the Self-Employed Income Support Scheme, were designed and delivered by the Treasury, working in close partnership with HMRC. This close working relationship may have been stress tested during the pandemic, but it was in place long before it. The Treasury and HMRC have long worked together through a formal mechanism known as the Policy Partnership. That relationship is unique within the United Kingdom government and enables the two departments to work together effectively as a single team. We will be exploring that relationship in this module and the extent to which it was instrumental to the rapid rollout of significant schemes that were generally considered to have achieved their policy aims and objectives. Identifying the strengths and successes of the policy partnership will also enable us to compare and contrast the success of other cross-departmental working relationships in the delivery of support schemes and in particular as between the Treasury and other government departments. We will explore issues that arose in cross-departmental working arrangements and the extent to which departments, and in particular the Treasury, were willing or able to share their own analysis and modelling with other departments. Some witnesses have suggested that working relationships with the Treasury were not always straightforward, with the Treasury being keen to receive data and analysis from other departments, but less willing to share their own internal analysis externally. Your Ladyship is taking a forward-looking approach to these issues, with a view to considering whether lessons can be learned and improvements made in cross-departmental working that would better enable the development of the economic response to any future emergency. In this regard, and highlighting what appears to have been a very good example of joined-up working at the heart of the United Kingdom government, we will explore the establishment of the COVID-19 Task Force, and in particular the Directorate General for Analysis, headed from the 19th of October 2020 onwards by Robert Harrison. This unit provided integrated data and analysis to the Prime Minister, Chancellor, and other Cabinet members, informed by multidisciplinary teams across areas including health, economics, and social policy. This enabled a coordinated effort across government, producing analysis that had a cross-Whitehall consensus. One of the core aspirations of this team was to ensure that as the pandemic progressed, policy was driven by analysis. We will examine the evidence for the need for a powerful analytical capability at the heart of government when responding to an economic shock such as that occasioned by the pandemic. Through an examination of schemes, including the Job Retention Scheme, the Self-Employed Income Support Scheme, and the uplifts to universal and working tax credits, your Ladyship will consider the extent to which their delivery benefited from the fact that the delivery experts for those schemes, particularly HMRC and the Department of Work and Pensions, were in the room from the outset of the formulation of those policies. Your Ladyship may consider that the relative success in policy development and delivery of the Job Retention Scheme, which also benefited from open, innovative thinking within the Treasury, is a good comparator against which to consider other schemes that appear to have been delivered in a disjointed manner and without adequate consultation with those responsible for delivery. The pace at which the Treasury was making and announcing decisions appears to have created challenges for other departments that then found themselves shouldering the burden of on-the-ground delivery. We'll explore those challenges in the course of the evidence, seeking to draw out lessons for the future. Good examples of schemes in which Good examples of schemes in which there was arguably confusion between scheme ownership and delivery included the grant schemes. These were schemes in which the Treasury, the Department of Business, the Ministry for Housing, Communities and Local Government all had an interest centrally, but which would be delivered by local authorities who were not consulted at the policy design stage. In a similar vein, there appear to have been less than clear lines of responsibility for the rollout of loan schemes as between those departments and the arm's length body of the British Business Bank. In the context of decision-making systems and structures, we will explore the working relationship between the UK government and its constituent departments and the devolved administrations in formulating the economic response. Although the largest schemes were designed and delivered UK-wide by the UK government, the devolved administrations were designing their own schemes to support people in Scotland, Wales and Northern Ireland. Were they given adequate notice of the UK government schemes or involved in the designing of them to better enable them to formulate and launch their own responses? And finally, in this broad topic area, we will also explore the extent to which the potential long-term health consequences of a novel virus were factored into the policy design of economic schemes, both at the outset of the pandemic and during it, as long COVID emerged as a recognised medical condition? Was there sufficient regard throughout when formulating policy to the risks posed to the economy in terms of scarring from long-term health conditions? My lady, that's 11:30 and the time for the break.
Thank you very much. I shall return at 1:45.
All right.
Mr. Wright.
My lady. I turn then to the third broad area, monetary policy. Whilst the majority of the focus in Module 9 will be upon the fiscal interventions, by which we mean the spending of public money by the government, it is important that we acknowledge that those fiscal interventions were complemented by monetary policy decisions taken by the Bank of England, principally related to controlling inflation. The Bank of England, whilst owned by the government, operates independently of it. As the government's banker, it has a key role in utilising monetary policy so as to ensure price stability in the context of inflation. Price stability means that prices do not vary wildly on a day-to-day, month-to-month and year-to-year basis. In simple terms, when the government was deciding which fiscal interventions to make and estimating the cost of those interventions, it was doing so on the assumption that the bank would fulfil its role of ensuring price stability. Predictability of pricing meant, for example, that when the government decided to spend tens of billions of pounds on the job retention scheme, the money it spent would have had a predictable real-life impact on the businesses and workers that the government was seeking to support. The primary monetary policy levers available to the Bank of England at any time are making adjustments to the short-term interest rate, known as the bank rate, and making adjustments to the bank's holding of government and corporate bonds by what is called quantitative easing or tightening, which has the effect of either lowering or raising the longer-term interest rate. In March 2020, the ability of the bank to make reductions in the bank rate was limited. The pre-existing and long-term low levels of interest rates that had prevailed since the financial crisis of 2008 left little room for significant lowering of the rate. The bank nonetheless acted quickly to reduce the bank rate from the pre-pandemic level of 0.75% to an unprecedented low of 0.1%. The purpose of making such a reduction is to make it cheaper for business and individuals to borrow money, leading to an increase in spending power and supporting demand for goods and services in the economy. Alongside a reduction in the bank rate, the bank engaged in several rounds of quantitative easing. In simple terms, the bank increases its balance sheet by buying UK government debt in the form of gilts, which has the effect of raising the price of those gilts and thereby pushing down their yield and the long-term interest rate. In March 2020, quantitative easing was increased by £200 billion to a total of £645 billion. That level increased to £745 billion in June and then to £875 billion in November of 2020. Lowering the long-term interest rate is intended to encourage businesses to invest and individuals to spend their money rather than save it. In the course of the hearings, we'll hear evidence from Andrew Bailey, the Governor of the Bank of England, and we'll explore with him the close working relationship between the bank and the Treasury throughout the pandemic. It was undoubtedly a crucial relationship to the overall economic response to the pandemic, ensuring a complementary fiscal and monetary response. We will also examine the limits of monetary policy during the pandemic. We will explore with Lord King, Governor of the Bank during the global financial crisis of 2008, the circumstances in which, in his view, monetary policy can and cannot help to manage an economic crisis. One area that the inquiry is interested to explore is the extent to which the use of quantitative easing and the extent to which it was used was in fact appropriate, given that the pandemic's effect was arguably felt most dramatically on the supply side of the economy as a result of the measures taken by government to tackle the health implications of the pandemic. It also appears that the justification for quantitative easing appears to have been, at least in part, to calm the financial market volatility. The inquiry wishes to explore the extent to which the true nature of the shock was obvious and understood at the time that the bank engaged in the first round of quantitative easing in March 2020, and when it was considering whether further rounds were appropriate as the year progressed. If so, given that some argue that there were also early indicators of substantial inflationary pressure in April 2021 onwards, we will consider whether the risk of rising inflation was sufficiently factored into the decision-making of the bank in 2020. The inquiry's interest in these issues is not in order that it can express an opinion as to the merits of the approach that was taken, but rather so that we can explore the extent to which lessons have been learned from the pandemic and can be factored into any response in a future emergency. Economists inevitably offer conflicting opinions of the success or failure of decisions taken by the bank at any time. The same is true of the decisions that it took during the pandemic. It is not the function of this inquiry to assess and rate the bank's decision-making in the course of an unparalleled emergency, not least because there is no counterfactual to test its performance against. In his expert report prepared for the inquiry, James Smith expresses the opinion that the decisions taken by the bank during this period of time have largely stood the test of time. At a high level, and moving on to the topic of funding, and linked with the decision-making systems and structures deployed by government, the module will consider how the UK government was able to fund its fiscal interventions and how it arrived at its funding decisions. In the course of these hearings, we will also consider funding for the devolved administrations in the course of the pandemic. We recognise, of course, that the Barnett formula provides the backcloth for any consideration of regular funding for the devolved administrations and emergency funding measures taken in the course of the pandemic. That said, the formula itself, its design, operation, and the political decisions often associated with it are not within the scope of this module and will not be explored in the course of our hearings. Rather, your ladyship's focus will be on the delivery of emergency funding through the Barnett Guarantee and the fiscal frameworks through which the devolved administrations operated during the pandemic. The Barnett Guarantee was introduced in the summer of 2020 by the United Kingdom government and applied until final spending plans for 2021 were published in March of that year. This provided guaranteed levels of funding to the devolved administrations at a level above that usually provided under the Barnett formula. This was intended to enable the devolved administrations to respond to developing conditions without needing to wait for the United Kingdom government to confirm additional funding. We will explore the structures for cross-nation working on funding, including the Finance Ministers' Quadrilateral, and the timing and certainty of funding announcements. We will also examine issues related to the funding of local authorities in England, Scotland, Wales, and Northern Ireland, including the levels of support, the mechanisms by which funding was delivered across the four nations, and the efficacy of monitoring by the United Kingdom government and the devolved administrations. We will consider in particular the extent to which it's both desirable and feasible to develop a framework for local government funding for use in the course of a future pandemic. Whilst the scope of this module includes consideration of additional funding for relevant public services, that does not equate to your ladyship examining in these hearings departmental spending decisions or the level of funds allocated by the United Kingdom government, the devolved administrations, or local authorities to particular public services. The focus of the module in this context has been throughout and remains on additional funding for relevant public services that were provided exceptional emergency funding because they were central to the economy. In particular, that extends to public transport systems throughout the United Kingdom. Looking to the future, your ladyship will consider the framework of funding of the devolved administrations in any future pandemic emergency, including the operation of any future Barnett guarantee, and whether or not it would be desirable to include in any future framework mechanisms that would enable the devolved administrations to fund divergent responses to any future pandemic. That would be potentially important if the impact of any future pandemic was significantly unequal across the United Kingdom. Similarly, we will explore the potential for a future emergency framework of funding for local authorities that would enable greater funding certainty through a method of assessing and monitoring increases to operating costs and reductions in income consistently. I move on to our next topic, support for jobs and the self-employed. The Coronavirus Job Retention Scheme, or CJRS, commonly known as furlough, was at the heart of the UK government economic response to the pandemic. The scheme was announced on the 20th of March 2020 and launched ahead of schedule on the 20th of April. In the first 8.5 hours of the scheme being live, 141,000 applications were made by employers relating to in excess of 1 million jobs at a cost of £1.19 billion. By the time that it finally closed on the 30th of September 2021, the Treasury and HMRC estimated that the gross cost of the job retention scheme had been £69 billion, with a net cost of £54 billion. That cost represented the saving of an estimated 4 million jobs across the UK workforce, the preservation of businesses across the economy that would otherwise have fallen into administration, and a resulting lessening of the economic impact of the pandemic. Praise for both the scale of the scheme and the speed of its implementation has been forthcoming from across the United Kingdom and across business sectors. Make UK, the representative voice of the manufacturing industry across the United Kingdom, observed in its questionnaire response to the inquiry that the most significant form of support for manufacturing during the pandemic was via the job retention scheme. Their assessment was that the scheme saved jobs, protected employees, and kept businesses afloat. Without the job retention scheme, they were confident that there would have been mass redundancies, as many manufacturing companies had planned to make up to a quarter of their staff redundant. Similar appreciation of the support offered to business by the job retention scheme was reflected in the questionnaire response of the Charity Retail Association, which considered the scheme to have played a key role in saving a number of charity shops from permanent closure. A number of contributors to Every Story Matters a number of contributions to Every Story Matters from workers who had been furloughed provided positive reflections on the operation of the scheme, noting its speed and the ease with which it could be accessed. As one person remarked, "I do believe the furlough scheme saved my career." Against this general appreciation of a well-focused scheme that was stood up at pace, what issues will this module focus upon with witnesses during the hearings? Well, in general terms, our focus will be largely forward-looking, aiming to identify whether in any future pandemic a similar scheme could be perfected to deliver better value for money and to increase flexibility and versatility. However, we will also explore the alternative policy options available to government in this pandemic, as they will equally be available in any future pandemic and will need to be thought through in the specific circumstances that present themselves at any given time. That is because the decision to place the job retention scheme at the heart of the economic response was effectively a policy decision by government to deliver the bulk of income support via business, rather than by providing support directly to individuals through welfare payments. The approach of the United Kingdom can be compared and contrasted with that taken in the United States of America. From a policy perspective, the expert consensus is that a number of factors will determine the extent to which it is desirable to link income protection with job preservation. In particular, the extent to which the pre-pandemic economic structure ought to be preserved, the likely duration of the pandemic, the feasibility of delivery, the practicability of targeting support, and the risks of long-term economic scarring, and the unequal nature of the economic crisis are all important considerations in reaching this judgment. Some criticism of the job retention scheme approach stems from the differing levels of support offered by government to different sectors of society, and in particular to those groups who were already economically vulnerable prior to the pandemic. In other words, those in low-paid employment or dependent on benefits were comparatively less well supported than those in well-paid employment whose incomes were maintained at or very close to pre-pandemic levels. Against that criticism, a number of factors are generally considered to have supported the decision to target support through job retention in the United Kingdom. First, the available data enabled the Treasury and HMRC to rapidly stand up a scheme in reliance on PAYE records. Correspondingly, data that would have identified the financial circumstances of households was limited. Had such data been available, it may be that a more targeted income support model would have been easier to design and implement. Second, the duration of the emergency is an important consideration. The advantage of job retention is amplified in a relatively short emergency, in which skilled workers remain aligned with their jobs as the labour market is temporarily frozen, allowing rapid recovery as soon as restrictions are lifted. The longer the pandemic, the less effective furlough schemes may become, as a stagnated labour market becomes harmful and the natural dynamic of a healthy economy in which efficient, innovative new firms that are more productive replace those that are not is itself stilted. We will seek to explore those criticisms. We will also explore the design of the job retention scheme and its inability to deliver support that was targeted to any real extent, for example by sector, geographical location, or by reference to whether a business remained open or was forced to close by imposed restrictions. We will investigate a number of examples of the Chancellor seeking to introduce elements of targeting into the scheme, but being thwarted by operational and other challenges. The advantage of targeting as a mechanism that protects public funds is obvious, as in theory, it ensures that only those in need of support receive it. The broader a scheme, the greater the sums of money that may have been legitimately claimed within the scheme rules, but not necessarily needed. This dead weight, as it's called, in the job retention scheme, was estimated to have cost the taxpayer £3.3 billion. There are other features of the job retention scheme in particular that we will consider, including the stipulation that employees had to be on the payroll by 28th of February 2020, later amended to the 19th of March, in order to be eligible. Whilst this was regarded as an important measure to prevent fraud, confusion over its application arguably left an estimated 470,000 employees in a state of limbo. The exclusion of company directors and whether payments should have been made in advance or in arrears will also be considered. Further, given the lack of targeting, should the list of companies that furloughed workers and was published in January 2021 have been published at the inception of the scheme? After it commenced in March 2020, the Coronavirus Job Retention Scheme was extended on 3 occasions, namely 12th of May 2020, 31st October 2020, and the 3rd of March 2021, with the scheme concluding in September of that year. The initial extension of the scheme was announced in good time and was an example of economic policy being complementary to the ongoing public health restrictions. However, the position in October 2020 appears to have been less clear. The Job Retention Scheme had been telegraphed to close on the 31st of October, to be replaced by a less generous Job Support Scheme. In fact, on the 31st of October itself, the Job Support Scheme was scrapped, as was the Job Retention Bonus Scheme, a scheme that had linked a bonus payment to companies retaining jobs through furlough and payable at the conclusion. We will explore the timing of this change of policy, and in particular whether or not it represented coordinated financial and public health decision-making and policy, notwithstanding that the extension of the scheme provided security to those workers who were furloughed. As one contributor to Every Story Matters put it, I think the extension of furlough was a lifeline. It gave me peace of mind knowing I had some income coming in. And finally, we'll examine the cessation of the scheme in September 2021, a decision that was taken in March of that year and therefore signposted well in advance. There are conflicting views as to whether or not the scheme should have extended further until at least Christmas of 2021, or conversely, whether it continued for too long, having ceased to have a positive economic effect, and resulting in the scheme overall representing less value for money. The continuation in August and September 2021, in and of itself, cost at least £1.1 billion net. Following the announcement of the Job Retention Scheme on the 20th of March 2020, guidance for that scheme was published on the 26th of March. On the same date, a scheme to support self-employed individuals, namely the Self-Employed Income Support Scheme, known as SEIS, was also announced. Often viewed as a complementary scheme to the Job Retention Scheme, it was intended to provide support to those self-employed individuals whose businesses had been adversely affected by the COVID-19 restrictions, and was a scheme designed at speed to enable support to be rolled out rapidly to the eligible self-employed. The first phase of the scheme opened for claims on the 13th of May 2020 and closed on the 13th of July. A second window for claims opened on the 17th of August, and an extension of the scheme was announced on the 24th of September 2020, 2 days after the Prime Minister had announced a new phase of national restrictions in Parliament. The second claim window closed on the 19th of October 2020, and third and fourth rounds followed in late 2020 and into 2021, with a fifth and final round opening on the 29th of July of 2021. By the 11th of August of that year, HMRC was indicating that they were seeing a significant decline in claims under the scheme, and the closure of the fifth round application window on the 20th of September of 2021 represented the effective end point of the scheme. Over the course of the 5 rounds of grants made under the scheme, financial support was provided to 2.9 million self-employed people at a gross cost of £28.1 billion, although that figure reduced to a net cost of £19.5 billion when recoupments through income tax and national insurance contributions were taken into account. The scheme operated by providing a level of income replacement to those who were eligible to apply for any of the rounds of grants. Without access to the scheme, those without any income would have had to have recourse to the welfare system, the means by which the state usually provides income replacement. One issue that may arise in the course of our examination of the scheme is whether or not there was in fact a sound economic case for such a scheme at all. Ordinarily, the self-employed are expected to find their own solutions for economic downturns, and their business model incentivises them to do so. Critics of the scheme maintain that its introduction was a result of political and not economic pressures, and that the self-employed were excluded from the job retention scheme, and that therefore there was a case for a complementary scheme. The mechanism by which the scheme was delivered relied heavily on the income tax self-assessment system administered by HMRC. Reliance on self-assessment arguably created a number of cliff edges in the eligibility criteria that we'll explore in the course of the hearings. The principal stumbling blocks to eligibility were, first, the exclusion of the newly self-employed. That was occasioned by HMRC not holding data on those who commenced self-employment in the 2019 to 20 tax year. Whilst that group became eligible in the 4th and 5th grant cycles, they were otherwise excluded. In contrast to the position of the United Kingdom government, the governments of the devolved nations implemented their own schemes that supported the newly self-employed, namely the newly self-employed hardship fund in Scotland, the Startup Grant in Wales, and the newly self-employed support scheme in Northern Ireland. Second, the operation of a hard-edged eligibility threshold at £50,000 annual earnings. The scheme had no tapering, and therefore resulted in the total exclusion of any person previously earning over that limit. Third, a further hard edge created by a stipulation that at least 50% of income had to be from self-employment. This had the potential to affect those who were in any event economically vulnerable. For example, in low-paid employment, supplementing their income with some element of self-employment, and often working in sectors that were the hardest hit by the pandemic restrictions. In addition to exploring those issues, we will also examine other aspects of the scheme, design and implementation. In particular, examining whether there was an appropriate trade-off between rapid implementation and the delivery of support on the one hand, and implementing a scheme that provided targeted support and represented a more effective use of public funds on the other. The ease of access to the scheme was certainly appreciated by those who received funding through it. As a contributor to Every Story Matters remarked, the criteria were quite simple. If you'd submitted tax returns and paid tax, it was based on your profit. You don't need to prove anything. It's the records that are held with HMRC that will be looked at. I already knew that I declared my income and I'd paid my tax, so it was something I knew that I'd be getting. As the rounds of grants continued, the application process was tightened in an effort to achieve an element of targeting. Looking forwards, we will consider whether any future scheme could or should include stricter eligibility requirements and could be designed around a broader data set to enable efficient targeting of support where it is in fact required. Similarly, we will also look at some of the gaps in the scheme, a good example being the initial exclusion of new parents, with an eye to identifying how any future scheme might avoid those omissions. We will also consider, in the context of our remit to examine steps taken to protect public funds, the levels of suspected fraud in the scheme, and why, given they sat at a likely level of 5.2% of all claims across the 5 rounds, they were notably in excess of the predicted level of 1 to 2%. As the support provided through schemes such as the Job Retention Scheme and the Self-Employed Scheme was coming to an end, a number of initiatives were announced that were forward-looking and focused on the need to rebuild the economy and jobs, and the jobs market as the pandemic restrictions eased. These included Kickstart, Restart, JETS and other bespoke schemes introduced by the devolved nations, such as JobStart and the Work Ready Employability Service in Northern Ireland. We will consider those schemes in a proportionate manner in the course of these hearings. Now, acknowledging that the support for jobs and the self-employed through the Job Retention Scheme and Self-Employed Income Support Scheme were a form of support for business, we are also going to investigate the wider economic support provided to business in the course of this module. In broad terms, that support was delivered through a series of business loan and grant schemes across the United Kingdom and the devolved nations. The central loan schemes that we will examine in the course of this hearing include, first, the Coronavirus Business Interruption Loan Scheme, so-called CBILS, the COVID Corporate Financing Facility, the Coronavirus Large Business Interruption Loan Scheme, the Bounce Back Loan Scheme, the Future Fund, and the Recovery Loan Scheme. The Coronavirus Business Interruption Loan Scheme was announced by the Chancellor on the 11th of March 2020 and launched on the 23rd of March. The scheme allowed businesses that had been adversely affected by the pandemic to access loan funding to a limit of £5 million with a government-backed partial guarantee for the loan repayments that was designed to encourage more lending by financial institutions. Similarly, the Coronavirus Large Business Interruption Loan Scheme, which was announced on the 3rd of April 2020 and introduced on the 20th of April, offered a partial guarantee to lenders advancing funds to larger businesses up to a maximum credit limit of £200 million. Each scheme was administered by the British Business Bank, a business development bank that during the pandemic was wholly owned by the Department of Business, Energy and Industrial Strategy, but operationally independent of that department. Over the course of the pandemic, in excess of £30 billion of funding was provided to over 100,000 businesses across the two schemes. These two British Business Bank administered schemes were aimed at smaller businesses than those eligible for support through the COVID Corporate Financing Facility, a scheme administered by the Treasury and the Bank of England directly, announced by the Chancellor on the 17th of March and going live on the 20th. That scheme was designed to support the UK's largest businesses by advancing in the region of £38 billion of short-term financial support by the date of its eventual closure on the 18th of March 2022. On the 27th of April 2020, the Chancellor announced a further tier of government-backed lending, namely the Bounce Back Loan Scheme, with the scheme launching a few days later on the 4th of May 2020, also administered by the British Business Bank. By the time that it closed on the 31st of March 2021, the Bounce Back Loan Scheme had seen over £45 billion of funding advanced to over 1.5 million applicants. The policy rationale for the introduction of this scheme was related to the inability of small businesses to rapidly access funds through the CBILS mechanism. The short-term cash flow pressures that were being reported by many SMEs was fed back to the Treasury by UK Finance as the representative body of the UK finance industry. It appears that despite the government backing of a significant element of any CBILS finance advanced, commercial lenders were conducting standard security and eligibility checks that were often taking many weeks to complete, just as they would have done in ordinary times. The Bounce Back Loan Scheme was therefore designed to provide an easily and rapidly accessible finance facility with 100% government backing to provide certainty for lenders and requiring only self-certification from borrowers with no credit checks being performed. A contributor to Every Story Matters identified the ease of the application process under the Bounce Back Loan Scheme as compared to the CBILS scheme, saying, Bounce Back was 100% guaranteed. It was a very light touch application. We just entered information that was required about our bank details, our company registered number, when we were formed. It was a 10-minute job, whereas with CBILS you had to put a cash flow forecast, profit and loss balance sheet together. The Future Fund, which was also administered by the British Business Bank, was announced on the 20th of April 2020, launched on the 20th of May, and advanced just over £1 billion of government-backed funding before it closed to new applications on the 31st of January 2021. It was a fund designed to match private investor funding in innovative business to a maximum value of £5 million. Finally, the Recovery Loan Scheme was announced on the 31st of March 2021. As the name suggests, it was designed to offer government-backed financial support to businesses as they recovered from the economic impacts of the pandemic. This scheme, which continues to exist, though rebranded as the Growth Guarantee Scheme, was also administered by the British Business Bank. During the course of the hearings, we will examine a number of aspects of these loan schemes. In particular, we will explore the architecture of the CBILS scheme that was built on the foundations of the pre-COVID Enterprise Finance Guarantee Scheme. That scheme was not designed with the emergency conditions of the pandemic in mind, nor was it a scheme that ever handled applications in the numbers seen by CBILS. The tension between designing a scheme at speed and the conditions of the scheme necessary to combat instances of fraud and error, thereby protecting public funds, will also be considered, as will the relationship between the British Business Bank and the Treasury as the scheme developed, and the bank warned of increased financial risks. Similarly, in the context of the Bounce Back Loan Scheme, we will consider the obvious trade-offs between a scheme that undoubtedly provided access to a rapid finance facility for over 1 million applicants, against a scheme that did not require lenders to conduct any credit checks, operated on a self-certification basis, and did not take into account the affordability of loan repayments. Not only will we explore the levels of significant financial risk inherent in such an approach, but also the vulnerability of the scheme to fraudulent claims, with current government estimates being that 1.88 billion, or 4.05% of monies drawn against the Bounce Back Loan Scheme, suspected to have been as a result of fraud. The relationship between the government, or government-backed institutions like the British Business Bank on the one hand, and the finance sector, as represented by UK Finance as a trade association, will also be explored to consider whether communication and collaborative working in a time of future crisis could be improved. The structural relationship between the British Business Bank, His Majesty's Treasury, and the Department for Business, Energy and Industrial Strategy is another important area of investigation. The British Business Bank was an arm's-length body of the Department for Business, Energy and Industrial Strategy, now the Department of Business and Trade, and therefore did not report directly to the Treasury. The impetus for the various loan schemes that the British Business Bank administered came from the Treasury, with the design of the schemes requiring close working between the Treasury and the British Business Bank. Despite that, another government department, the Department for Business, Energy and Industrial Strategy, was responsible for the delivery of the schemes. And this created a position in which the accounting officer of one department had to seek ministerial directions for the schemes from that department's ministers, despite those ministers not having been closely involved in the development of the schemes. Finally, acknowledging that internal reflection has already taken place and that lessons will undoubtedly have been learned, we'll conclude our consideration of this topic with forward-looking evidence from the current Permanent Secretary of the Department of Business and Trade, the successor department. In particular, we'll explore the current levels of preparedness for the delivery of a comprehensive economic response as compared to that state in 2020. And in doing so, we'll have regard to playbooks for a future pandemic that have been and are being developed. As I've indicated, we will also examine the various grant schemes that were used to deliver support to business across the 4 nations of the United Kingdom. These were discretionary payments that did not need to be repaid by the businesses that received them. The grant schemes in England were launched in 3 cohorts, comprising a total of 8 separate grants. Taken together, these represented a major fiscal intervention with support delivered to an estimated 1.4 million businesses through over 4.5 million grant payments delivered by 314 local authorities across England to a total value of £22.6 billion. In common with other interventions, the schemes were developed at pace, with an initial cohort being announced on the 11th of March 2020, with guidance issued to local authorities on 23rd of March, and funding for the schemes provided to local authorities on the 1st of April. The first cohort comprised the Small Business Grant Fund, the Retail, Hospitality and Leisure Grant Fund, and the Local Authority Discretionary Grant Fund. The grant schemes were intended to deliver speedy financial support to small businesses in a targeted way, and within 4 weeks of the first round of funding being provided to local authorities, 70% of the monies had been paid out to eligible businesses. That rapid delivery was, on any view, impressive, all the more so because local authorities had not been consulted as to these schemes, their design, or their role in delivering them. Moreover, there was no pre-existing infrastructure for delivery. The second cohort of schemes launched in September 2020 and ran until March of 2021. Rationale for the schemes to deliver targeted and speedy financial support to businesses affected by the public health restrictions remained the same. The second cohort also comprised grants that were designed to support businesses affected by tiered restrictions and the second and third national lockdowns. Funded centrally and delivered locally, as with the first cohort, the second comprised the following schemes: the Local Restrictions Support Grant, which itself subdivided into a number of discrete schemes, the Additional Restrictions Grant, and the Christmas Support Payment. The third cohort of schemes ran from April of 2021 until March of 2022 and was initially designed to support businesses reopening and recovering from the third national lockdown. Later, a scheme was introduced to focus on the hospitality sector, dealing with the emergence of the Omicron variant in late 2021. And the schemes in the third cohort were the Restart Grant and the Omicron Hospitality and Leisure Grant. The Scottish and Welsh governments developed their own grant schemes to be delivered to businesses by local authorities. In Scotland, £4.6 billion was paid to businesses through funds in 2 phases. In Wales, support for businesses was delivered primarily through 8 phases of the £2.6 billion Economic Resilience Fund. We will examine the working relationships between the Scottish and Welsh governments and their respective local authorities. In Wales, consultation on design and delivery took place through the Partnership Council for Wales, a pre-existing forum which enabled consultation in the design and delivery of those business grant schemes. Business support in Northern Ireland was delivered directly by the executive. Nearly £1 billion, 958 million to be more precise, was paid to businesses through funds such as the £10,000 support scheme for small businesses and the £25,000 scheme for retail, hospitality, tourism and leisure. In the course of the hearings, we will explore with the witnesses the challenges that arose from the speed at which the grant schemes were developed and the resulting increase in risk of fraud and error. The rate of irregular payments under the first cohort of English grants was in the region of 4.6%, or £1 billion in cash terms. Another important area of investigation will be the apparent lack of consultation between central and local government about the design and delivery of the schemes, in particular the first cohort. Policy was being formulated centrally, yet delivery was to be performed by local authorities without adequate scheme architecture. We will also examine the effectiveness of the relationship between the United Kingdom government and English local authorities in the economic response to the pandemic, and make comparison as between those relationships and those in the devolved administrations. Although the delivery of support was delegated to a local level, with the resulting risk of unequal delivery across the United Kingdom, contributors to Every Story Matters praised local authorities for their effective explanation of the available support. One person from England said they were quite good through our council. They were sort of a purpose-built website for businesses, and that gave you access to grants and all sorts. Another sole trader running an arts and entertainment business in Wales observed, so we did get emails from our local council. There was like a kind of newsletter type thing that came out to let us know of all the things that we could apply for, all the help that was available as and when it came out, basically. Finally, we will examine how, as the various grant schemes were rolled out across the 3 cohorts and developed in response to the rapidly changing social distancing restrictions, there came to be multiple schemes and sub-schemes in existence, each of which had its own eligibility criteria, rules and guidance. We'll explore how this complexity arose and the effect it had on their delivery and efficacy. As another contributor to Every Story Matters said, it's actually knowing what avenue to go down, because there was so much out there. You type on different things and you're just going down a whirlpool, really, because you don't know what you're looking for. You don't know if it's the right one. I've already outlined the uneven economic impact of the pandemic and noted that many who were economically vulnerable before it began were likely to be more adversely affected by it economically. This module is, of course, concerned only with the economic response of government. When we come to consider measures that were capable of alleviating economic hardship, it's important in the hearings that we maintain a focus only on economic measures and not on other forms of support that were provided. Under the broad umbrella of considering measures that were capable of alleviating economic hardship, we will investigate the uplift to universal credit and working tax credits and the support provided to the voluntary and community sectors through a £750 million package of support. Consideration of the uplift to universal credit and working tax credit inevitably engages a consideration of the benefits system in the United Kingdom as the means through which those measures were delivered. My lady's consideration of the benefits system in this module does not extend to an examination of the political decisions taken historically as to the shape of that system or as to the level of benefits available within it. Module 9 is concerned only with the economic support delivered in response to the pandemic. As early as the 27th of February of 2020, the Chancellor sought advice from his officials as to the options for a package of support for individuals. That request included a specific request for the issue of statutory sick pay to be considered. Early advice to the Chancellor posited a number of options dependent on the severity of the economic impact of the pandemic, but included a series of options for the reform of statutory sick pay. On the 2nd of March, the Prime Minister and Chancellor commissioned HMRC to work up a statutory sick pay rebate scheme to support small and medium enterprises, and delivery advice was rapidly provided. In addition to making eligibility changes to the statutory sick pay scheme, many of which were examined by your ladyship during the hearings in Module 7 of the inquiry, and which we will therefore not be reconsidering in this module, the UK Government also introduced the statutory sick pay rebate scheme on the 26th of May 2020. The scheme was designed to ameliorate the increased cost to business of statutory sick pay, and therefore represented a policy decision to shift the economic responsibility for statutory sick pay payments caused by the COVID-19 from employers to the state. We will investigate the scope of the rebate scheme, and in particular whether the decision to confine its application to claims of no more than 2 weeks absence per employee and to businesses employing less than 250 people was appropriate, with discussions on that issue taking place between the Treasury and the Department of Work and Pensions in August of 2020. The speed at which the rebate scheme was rolled out is another factor that we will consider in the context of safeguarding public money. Was there adequate monitoring of the economic impact and value for money of the scheme? And were there increased risks of fraud associated with that rapid rollout? We know that the Chancellor discussed those risks with officials at HMRC as early as the 10th of March of 2020. We will also explore the cessation of this support and the initial decision to close the scheme in 2021 being taken by the Secretary of State for Work and Pensions and the Chancellor. That decision appears to have been one taken against the advice of Department of Work and Pensions officials and was rapidly superseded when the scheme had to be reopened due to the increase in infections resulting from Omicron. The scheme closed initially on the 30th of September, but was reopened by the 20th of December 2021. On the 19th of March 2020, the Chancellor decided to implement a temporary uplift to universal and working tax credits at the rate of £20 per week for a 12-month period. He stated that when they were announced that these measures would benefit over 4 million of the most vulnerable households. A range of experiences related to the adequacy of the level of uplift to universal credit was shared with Every Story Matters. One person said, "When that extra £20 did come in, it was a huge saviour. It really, really was, because they took away a lot of stress. A lot of the other women, they didn't think it was much of a help, but for me, that £20 was going to go a long way." Whereas another remarked, "I don't really think that uplift was that great. In terms of what I had to spend paying off things, I don't really think that was enough, if that makes sense. It still wasn't enough." On the 25th of March 2020, the same day that the Coronavirus Act came into force, Department of Work and Pensions ministers were asked for approval for regulations to bring the uplift into effect, and at the same time to disapply the minimum income floor for self-employed universal credit claimants. This had the effect of linking support for self-employed claimants to their actual earnings rather than an assumed amount that they were not in fact earning. The advice to ministers was that it would not be operationally deliverable to apply a similar uplift to legacy benefits, such as the Employment Support Allowance, Job Seekers Allowance, or Income Support. The regulations that gave effect to these changes came into force on the 30th of March of 2020, and the uplift was applied to Universal Credit Awards from the 6th of April. In the course of our hearings, your ladyship will explore the policy rationale for the introduction to the uplift and how the policy was communicated to those who were entitled to receive it. The uplift appears to have been designed to support those who had recently faced financial disruption as a result of the pandemic, as opposed to extending support to all of those who were economically vulnerable in general. Certain questions therefore arise. Was the introduction of an uplift to certain benefits in order to help this particular group in this way justifiable? Or should the government have introduced an increase in benefits that was intended not only to help people who'd lost employment or income, but also low-income families who faced additional or increased costs as a result of the pandemic? Similarly, if the uplift was designed to support a class of pandemic claimants who'd lost employment and seen sudden sharp drops in income, why was a universal uplift appropriate? We'll explore these questions and the trade-offs between rapid rollout of support and taking a more targeted approach to delivery. Although working tax credits are regarded as a legacy benefit and did receive the uplift, other legacy benefits were excluded. We'll investigate why this decision was made, including the policy rationale for excluding legacy benefits generally, at the same time as not relying solely on universal credit to deliver the uplift. The uplift was introduced as a temporary measure in response to the economic emergency. On the 9th of October 2020, the Secretary of State for Work and Pensions wrote to the Prime Minister regarding its future. The letter confirmed that her officials had been asked to explore a number of options relating to universal credit, including the option of maintaining the uplift. The Secretary of State expressed her preference for a permanent uplift to be applied both to the Universal Credit Standard Allowance and to the child element, each at the rate of £10 a week. A month later, on the 9th of November 2020, a meeting took place between the Secretary of State and the Prime Minister regarding the future of the uplift, at which she repeated her view that the uplift should become permanent. And a trilateral meeting, including the Chancellor, was booked for the 15th of January 2021. In December 2020, it was recognised by Treasury officials that extending the uplifts could help support macroeconomic demand during the recovery. However, they cautioned about long-term fiscal sustainability. A trilateral meeting took place and a number of options were considered, from removal with a one-off compensatory payment, through various options for extension, through to making the uplift permanent. And on the 3rd of March 2021, the Chancellor announced a 6-month extension of the uplift during the spring budget. In a briefing prepared by Treasury officials on the 21st of May, the Chancellor was briefed on the impending withdrawal of the uplift. Various options were raised, included tapered reduction and extension. The removal of the uplift was predicted to have a disproportionate effect on households with the lowest incomes and as being likely to increase child poverty. The analysis of the Department of Work and Pensions suggested that removal would place 800,000 adults and 300,000 children into poverty. Ultimately, the decision was taken to remove the uplift as planned, and that removal took effect on the 6th of October 2021, with the last uplift payments being made on the 12th of October. A contributor to Every Story Matters described the effect of the removal of the uplift in this way. The end of the uplift was really difficult. I wrote to my MP and said, can we keep the universal credit uplift? As much as our bills went up, they never really come down, but the support stopped. I got to a point where I was having to borrow money from family just to pay my bills because the money had stopped. Accepting that the removal of the uplift had the potential to significantly impact those who'd been in receipt of it, the consideration of whether it should have been removed whether universal credit should have been permanently uprated, and the level of support available through universal credit generally are all issues that appear to be outside the terms of reference of your ladyship's inquiry. However, and with a focus on the economic response to the pandemic, we will consider how the decision to remove the uplift was arrived at and explore the timing of that decision. In addition to the uplift itself, the Department of Work and Pensions also introduced a number of easements to the universal credit and other benefit application systems. Under the Trust and Protect regime, information that would have previously been captured face-to-face was accepted from claimants over the telephone and verified retrospectively in case reviews, face-to-face for assessments having been suspended from the 17th of March onwards and job centres closing on the 24th. From April 2020, the Don't Call Us, We'll Call You campaign resulted in calls being made to claimants if information needed to be verified and increased resource to online systems and messaging. We will examine why these easements were introduced, whether they were principally designed to speed up delivery of the uplift, whether fraud and error increased as a result, and whether more could have been done to deter fraudulent claims from the outset. Many of these changes not only impacted on applications for benefits, but also upon the level of support that was available to those who were seeking employment. As one contributor to Every Story Matters remarked, I used to go to the Job Centre Plus every 2 weeks or every week, and when they switched everything off and went online or on the phone, it was quite strange. No training was offered at that time. Looking to the future, we'll be keen to examine how systems could be developed now to ensure that in a future pandemic, government will be able, if appropriate, to deliver more targeted support by way of an uplift. Similarly, whether upgrades could be made to legacy systems or other changes made to ensure that the delivery of support through an uplift was an option for those relying on benefits benefits other than universal credit. We'll also consider whether risk of fraud and error might be mitigated by a clearer indication when any uplift is initiated that retrospective additional checks to eligibility will be applied. The final area that we're going to examine in the course of this module is intended to be entirely forward-looking. Pulling together the evidence that we'll hear across the next 4 weeks, we'll examine the lessons that have already been learned, the developments in thinking, the changes to systems and structures that have already been put in place to better enable the management of economic risk and safeguarding of public funds in any future emergency. Returning to the theme of data and analytical capability, we will explore the ability of the government to access appropriate data sources during the pandemic and consider improvements to that data capability that might be made. We will also focus on the extent to which the analytical capability or capacity of government, the type of function that Robert Harrison and his team at the Directorate General for Analysis were performing during the pandemic, have been enhanced or improved. We will consider whether further steps in this regard are necessary and appropriate to better inform the economic policy response of government in any future pandemic-level emergency. My lady, I am now approaching the conclusion of this opening address, through which I've sought to identify the structured approach that we will take to the calling of evidence and the examination of the key issues that will be explored over the course of the hearings in this module. I will then give way to the representatives of those core participants who wish to make opening statements. Before I do, I want to thank the core participants and their legal representatives for their continued constructive engagement in this module, which has greatly assisted my team in their preparation for the hearing. And as one final point before I think your lady takes the lunch break, may we have permission, please, to adduce the Every Story Matters record into evidence.
You may. Thank you very much indeed. Vijay, I think you're up first, but I think we'll take you this afternoon if that's all right. I shall return at 10 to 2.